The Federal Reserve just cut interest rates by 0.25%, which is the third cut this year, after similar moves in September and October. So this is a slow, gradual easing trend, not a big emergency slash of rates. But here's where it gets interesting. The vote inside the Fed was split. One member wanted a bigger 0.5% cut, and two members did not want any cuts at all. That is the biggest disagreement we have seen in the Fed in years. So what does that mean for you and for mortgages? First, mortgage rates do not move in a straight line with the Fed's funds rate. They follow what investors expect for inflation and the broader economy, not just what the Fed does at one meeting. Because this cut was widely expected, a lot of it was already priced into the bond market. That means mortgage rates may not drop overnight just because the Fed moved by a quarter point. In fact, on some recent cuts, mortgage rates have actually stayed flat or even ticked up a bit as markets react to the Fed's comments, not just the headline. Second, the outlook the Fed gave for 2026 matters. Right now, they are only projecting one more small cut next year. And some members are still arguing for no more cuts, or possibly even a rate hike. That tells you the Fed is not convinced that inflation is fully tamed. This means you will likely see windows of opportunity where rates dip and then bounce, rather than one smooth decline.